let's continue. Basic accounting principles. We are now in conservatism or prudence principle. It states that given the option in the valuation of the transaction, the amount to be recorded should be lower than the higher value. So take note of the keyword there. It's if the situation arises. So that conservatism doesn't mean that we deliberately choose the lower amounts. That doesn't mean that we will put lesser income or lesser asset amount, because that might lead to tax evasion. It only means that we don't recognize income yet. If it's not yet, if the services are not yet delivered, if the goods are not yet sold, we only recognize income when the transaction is already completed. So, for example, when a company is encountering a lawsuit or is faced with a lawsuit, the company should provide. So instead of assuming that we can win that lawsuit, maybe the company should provide for a liability pertaining to that lawsuit, because conservatism dictates that we provide for the less effect on net income. So of course, if we provide for a lawsuit, we will recognize in our books losses. So the effect will be lesser on the net income, so less amount of asset, because our liability will increase. So conservatism or prudence, it doesn't mean the intentional or deliberate lowering down of assets or income, but rather we only provide for lesser income when faced with situations that requires lesser provisions. So you are just being conservative, not deliberate distortion of the financial statements. Let's continue. Basic accounting principles. Next is objectivity principle. So this requires this transaction to have some form of, the keyword here is impartial. So it must be supported by evidence or documentation. Objectivity can be accomplished by performing the following when doing your bookkeeping and financial recording. Number one, it should be done independently. Independence has two phases: independence in appearance and independence in fact. When you say independence in fact, you truly are independent. That means in your mind, you don't have the bias that you can do it. Then we have another phase, which is independence in appearance. So for example, even though you are independent in fact, in your mind, you feel that whatever is true, I will write this. But, for example, you are the bookkeeper of your family's business. So you cannot take it away from the outsiders to think that you might not be recording the right records, because in appearance, they will think about the bias because that's your company business, or you are working for your father's business. So we have independence in fact, what's going on in your mind, and independence in appearance, what the people sees. So we must satisfy those two independence. Then we also have free from bias. Of course, just how I mentioned, when you say free from bias, that means all parties are being served well, not just in favor of, say, the company, or in favor of the employees, in favor of the management, but rather, so we record as it is, free from bias and prejudice. Of course, we record transactions not just by thinking of what will the outcome be. It's similar to free from bias. Okay, we also have here the slides for other characteristics of accounting program or other characteristics of accounting information, I believe accounting program is written in your handouts. But to me, I feel like it's more of a characteristics of accounting reports. So anyway, so financial reports generated by professional accountants, accounting information presented must be reliable and verifiable. When it is reliable, meaning just now we mentioned it is reliable when it is free from bias. It's supported by documents. Verifiable also. Actually, they are interrelated. The reliability of the information is increased when it is verifiable. So, if I can check that really you purchase, for example, you purchase an equipment for 50,000 and I verified in your accounting records that it is 50,000, that makes the information verifiable. So after I verified, then its reliability of the information presented also increases. That's why they are interrelated, verifiable, reliable, and verifiable. Another important characteristic here is consistency and comparability. So they are also interrelated because consistency, as I mentioned in part 1 of this video series, consistency means you record, you apply the same accounting principle from one period to another. Comparability means you can compare the figures from one period to another. So, if you apply accounting principles consistently, it increases its comparability. Because it's very hard to compare, for example, an accounts receivable where you apply, say, when you compute for your doubtful accounts, you use the percentage based on accounts receivable, then the following year, you change your percentage to percentage of sales. That's why they come hand in hand. Financial reports are more comparable when the accounting principles are applied consistently. So that's why they come hand in hand as well, consistency and comparability. So these are the most important characteristics of financial statement that enhances the value of financial statements. If they are reliable and verifiable, as well as consistent and comparable. So relevant information help decision maker understand the company's past performance, present condition, and future outlook. Again, relevance depends on the individual's need. Technically, it's just their concern. If it doesn't concern me, that is irrelevant to me. That's the simplest explanation you can get. If it affects my decision making, that's relevant to me. If it doesn't affect my decision, it's irrelevant. That's why for external users, they might be interested in company's value. For example, when we buy stocks for big companies like Jollibee's, PLDT, telecommunication companies. So you're interested for the company's value. When lenders extend loans, they will ask for their financial statement, of course, to evaluate if they are capable of paying their loans. So those are externals, I mean, outside parties of the company. They are called external users. External users are lenders, investors, government agencies. Internal users are those users that works or are part of the company. They are working inside the company. That's why they are called internal users. So you have management and also employees. So their need is also different. So for example, management, they are concerned with how much our sales last year, so that will be the basis for our sales next year. That will also be the basis for the preparation for the production, manpower scheduling. So employees also uses company's information. If they are asking for, of course, if they validate if the wages they're getting, the salaries they're getting are in line with the company's earnings. And a lot more of users. Management also uses this information to evaluate salaries they're giving to the employees, as well as preparation for the corporate for employees' retirements and other benefits they can get from for the employees, and they will get it from the company financial statements to verify if it is reliable. Thank you.